Good afternoon. Welcome to a special update from Select, which is outside of the normal rhythm of our bi-monthly webinars. I trust this all finds you in good health, and hopefully you're all sitting at home like we are now and getting used to our new working environments. And we, as you know, Select and the JMI team are all working from home, so we're all getting used to actually working in a slightly different environment and getting to know our different surroundings, and trying to work as well with a whole lot of family members obviously around us as well. But I trust that the transition has been okay. If you look, it's been a period of unprecedented everything really. We've had volatility, we've had market movements, we've had announcements, fiscal and monetary policy responses, and most people at the moment are simply just trying to keep up with their own personal situations. So we very much understand that managing your client expectations, managing the client experience through this period is particularly difficult, and we do understand how challenging that can be. And hopefully today will give you a little bit more information to handle, one, to understand what's going on with your portfolios out there, what our views are, and how you can discuss some of these things with your clients. So what I thought I'd start, I'll talk about the current situation, a little bit of a chat about the virus and about what's happening in markets and market responses, and then we'll look at the client portfolios and how JMI Wealth have been managing the portfolios in the current environment. So let's look at the current situation first. Look, it's an extremely fast-moving situation, both in terms of the cause and the market responses. Now, I would say that the last couple of days have felt a little bit less frantic, but we've set so many records in terms of market movements, market responses, and I think over time we'll understand perhaps why this has been the case, and I think maybe there'll be a slightly more inspection given to things like algorithms, so things like momentum, computer trading platforms, so things like the influence of passive funds. But at the moment, that is part of our landscape, so we do very much have to deal with that. So it's very fluid. We've got information flow changing materially every day, and that's not only on the underlying cause being the virus, but also what's happening in terms of market and market responses. I mean, the rapid global pandemic has caused the most aggressive sell-off that we've seen in market history. So I just want to assure you that we are monitoring events exceptionally closely. I can assure you that there are very long days being worked by a lot of people around the joint at the moment. We do have to come back to certain benchmarks, certain disciplines that help us manage client portfolios and model portfolios through this period, and that we do rely very heavily on our asset allocation frameworks. This literally has been a once in 100-year black swan event, which tests a lot of these systems and certainly tests a lot of the people. And the fundamental issue that we've got now, that we're looking at now, is that what's good for human health, and this in terms of the lockdown that we're about to step into at 11:59 p.m. tonight, is not necessarily good and actually can be bad for economic health. But from our point of view, what we've seen in other jurisdictions, the idea of going hard and going early seems to be the key to getting on top of the virus. And from our investment point of view, we think where we are in New Zealand right now is the right place to be. But I can't stress how important it is economically that we all play our part now, that we've decided to go into this environment. We've shut everything down. Hopefully the economic shock will then be, the bulk of the damage will be confined to the next 4 weeks, and then we'll be able to start working our way out of it. But we all must do our part, and I suppose it's important that we do stress that, as well as the economic side of it. We've actually all got to do our part socially over the next few weeks. Now, there's an interesting counter view to this, and we'll chat a little bit later on about some of the places where they've perhaps had a little bit of a counter view to this, to the going hard, going early. President Trump seems to be leaning towards maybe the less intrusive approach. We'll talk about that a little bit later on. So from our point of view, and certainly in terms of looking at portfolios, looking at how we manage portfolios, one of the real keys here is the duration of the economic dislocation. Now, for us to be able to make some calls about that, or to try and think about what the impact on the market is going to be, we have to look at certain measures. We have to look at certain, I suppose, factors that we see around us. So we're really putting these in terms of thinking of what stage of this cycle that we're at. There's three key issues for us, or three key elements of it. Is the spread of the virus slowing? So let's look at those various numbers that we're seeing, that we're bombarded with on a daily basis. Is the spread of the virus slowing? And what actions are being taken to slow or change that spread? What treatment options are becoming available? What progress is made on vaccinations? We know that there's a bit of a lag on that, and that could take some time, but is the progress? But I'm pretty sure you'll agree with me that once the market believes progress is made on these, then that changes the market reaction. The market will anticipate those. And of course, testing and management around to us, that's key as well to how we respond, how people respond economically in terms of markets when they think the solution's there, when they think things are under control. That to us certainly will be evidence of perhaps that we're going to see a turnaround. So just in terms of looking at that, what are we seeing at the moment? And I think we'd like to point out that in certain places of the world, certainly in the last couple of days, there does seem to have been some evidence that there is some control being found. We do know that we had the epicenter of this disease originally, where it originated was in China, the Wuhan, Hubei area, and so we all were staring at those numbers with enormous amount of inspection. Now this epicenter does appear to have moved to certain parts of Europe, so we're looking at Spain, potentially Portugal, but Italy does appear to be the latest epicenter. So we're looking at are those European jurisdictions getting on top of this? And there are signs that in Europe that they are slowing the spread. This is a chart, just looking back, you may not be able to see that those are dates there to the right of this chart. On the bottom x-axis, you can see the March dates. You can see that quite exponential growth at the beginning, but the last 3 or 4 days, it does appear to have been a certain amount of control, and we're not seeing that jump. Clearly, we need to see this being more of a trend, but I'll just illustrate that for you in another chart. And here you can see that, as I say, we need to see it being more extended. But right here, we're looking at the various countries in Europe. We're looking at the average compounded daily increase across 3 days through March 21st, and then the daily increase on March 22nd. You can see there was substantial fall, not just in one area, so it wasn't a statistical anomaly in one place. It does seem to be evident across a number of places. So we need to see whether or not we get more of a convincing trend here over time. However, we do have a couple of areas where we're not so sure about. Obviously, a couple of very large areas that I think are of great interest to people around the world, and that's India and then Africa. Both places that may have, that one either may have, limited access to healthcare or incredibly dense population bases in the case of India. But the one I really just want to talk about very quickly is the US, because the US to us remains an area of extreme interest, and it's pivotal from the point of view of economic outcomes, because of course its importance in the global economic environment. And as you can see at this stage, we're still seeing that first stage where we see this exponential growth. And the other issue that we've got that's probably, I think is going to be key in terms of how this plays out is there appears to be a lack of coordination at the moment between the state and the federal responses. Now, while we only hope it's his normal public positioning, Trump does seem to have an interesting stance on this. He was slow to acknowledge it, slow to move, slow to respond, and now seems to be a little bit unrealistic in terms of his timing as to when America's going to step out of the various restrictions that have been placed at individual state level. And of course, we've got another little epicenter developing in New York. So we're keeping a very close eye on that. We've seen a change in the way the UK, I haven't spoken about the UK. The UK responded initially looking at it perhaps from the point of view of developing a herd immunity. They seem to have changed that view more recently. But so many places to keep an eye on in terms of trying to understand when this might be plateauing, and when it might be time to start looking at the markets with a little bit more interest, and I'll come back to that a little bit later. Now, the economic impact of this will be severe, but it's not going to be eternal. This thing will pass, it will have an end. However, at the moment, we don't know. What we really don't know is that duration aspect that I've just been talking about. I'll say it again, the duration is key. Is this going to be a short, sharp shock or a longer and potentially more pronounced impact? There is so much guesswork going into these numbers at the moment. This is a Goldman Sachs forecast of global GDP. Currently, they've got it going down to -1. That's global GDP. I just do want you to take note very quickly. You're starting to hear about some economists talking about the impact on US GDP. Just be very careful there. What they tend to do in the US is they take the quarterly number and they annualize that number. So if they think they're going to get a quarter of -5%, they talk about -20% annualized growth. Remember that is not necessarily what the annual number is going to be. And I just want to talk very quickly about a slightly more technical note here, and that's at times like this, you do start to see people saying, hey, the market's got really cheap. This is from a price to earnings point of view. What you do get here now is we've seen a response in the price, but we haven't seen a lot of earnings downgrades come through. We haven't seen a lot of people redo their earnings forecasts. Once they come in with those earnings forecasts, then you'll get a slightly more realistic view of where the price to earnings multiple is going to be. But what we need here is a little bit of water to pass under the bridge before people start looking at some of these fundamentals, and we're not just looking at the sort of animal spirits driving markets on a day-to-day basis. The other point that I thought it was relevant to bring up, and please don't take this chart as being a recommendations chart. What this chart is really illustrating, this is from Forsyth Barr, some interesting work they did, and that's what this illustrates is that there's certain companies, different companies are going to respond differently to the COVID-19 economic impacts that we're seeing. There are those companies that are going to be more exposed to this. Air New Zealand, Tourism Holdings, this is in the New Zealand context, Kathmandu Holdings, people like Sky City, where these companies either have to suspend or close their operations, versus companies that actually are going to be more resilient. And we'll see this impact right around the world. So what I do want to say is at the moment, there's a lot of sort of everything's getting sold, maybe except Fish and Paykel Healthcare, which has responded extremely well through this period, but everything tends to get sold. But over time, as we get a little bit of stability, people will realize that they are actually going to be different outcomes from different companies. What I want to talk about now is I just want to have a little bit of a chat about the various portfolios and what we've been doing from a select point of view. I actually know quickly, I just want to I do just want to make the point, there's an enormous amount of fiscal and monetary policy response that's been thrown at these markets around the world. Now, this is huge. In fact, it's so hard, it's hard to keep up. What we've had here is looking at this in terms of percentage of GDP, and you can see the sort of fiscal and monetary policies we were looking at pre the outbreak of the virus, and you can see what we've got now, and in some cases this is enormous. And I just want to point out, in the US, the fiscal response that we've seen in the US, or the Fed response in the US, has been absolutely huge. Not only has it been huge, but it's been incredibly quick. In the last week, we've seen almost the same amount of Fed action that we saw in 3 years between 2009 and 2012, and we're currently, just last week, we saw about 2/3 of the whole of the action that we saw through the GFC. So once we get out the other side of this, once we get the virus under control, this does represent an enormous tailwind to markets. Right, now I just want to quickly work through our investment view, where we're sitting at the moment. We've moved the portfolios to more of a defensive tilt. These are the select wealth management portfolios. I just want you to be very aware that when we went into the virus, we already had the portfolios with a slightly cautious tint. And in fact, I do recall we may have taken some criticism for that. We had probably been anticipating something of either an end to the rally for some time. We certainly hadn't been anticipating anything of this speed and of this magnitude. The issue we've got within the portfolios still need to be true to their label. If you're investing in a balanced portfolio, that does need to be in a balanced portfolio. We do have some ranges that we can work within, so we're actively managing the assets within the portfolio, and we're also using the boundaries that we have to set the portfolios to an appropriate stance. I also want to make the point that the individual fund managers within the portfolio are also actively managing the risks within their individual portfolios. Markets are very volatile, and in some cases they're very illiquid. What this will mean is we could see quite a few swings in terms of pricing over the current period until the market settles down a little bit, which we hope will be soon. We'll hope for all of our stress levels it's going to be soon. So just to summarise the asset allocation position across the various portfolios, if we look at the conservative portfolio, that tends to have that currently we've got 73.5% of the portfolio in income assets versus a 75%, which is the strategic asset allocation. You know, you'd say, hey, Andrew, you're actually underneath, but we do have 5% of property in there as well, which gets recorded under the growth assets, but it's one of those ones where there's always a discussion as whether that should be a growth or an income asset. If I include that, we're actually at 78.5. The conservative is in line with its asset allocation, but the balance, the growth and the high growth, they all are over their exposure to income assets at the moment. 50% in case of the balance versus 45, 28% in terms of the growth versus strategic asset allocation at 21 and 11.5 for the high growth portfolio. So we're working within the boundaries that we have, and very importantly, we're ensuring that the assets within the portfolio are also appropriate for the current period. And one of the issues we've got at the moment is, of course, we use fund managers across the various asset classes, and I just want to illustrate that some of the fund managers are taking a pretty cautious stance within those funds as well. So this is just 6 of the Australasian equity funds that are in the various portfolios. This is the amount of cash. This was all as at the 23rd or the 24th of March. So this is either as at 2 days ago or 1 day ago. You can see there's a range there. Devon Alpha carrying 39% of the portfolio in cash. Harbour Equity Income 30%. They obviously are allowed to do that within their mandates. The mandates for Harbour and Australasian Equity Income, Devon Trans-Tasman don't have as much flex. You can see where the fund managers are able, they have used that ability to go to cash, and I think all of them now are starting to think, when should they be putting that? They have the ability to think now about when should they be putting that cash back into the markets. So I just want to go through each of the portfolios just quite quickly. We won't spend too much time on each portfolio because there are a lot of common themes. The conservative portfolio, as I said, it looks like we're slightly under the strategic asset allocation, but we have quite a defensive equity selection here. We've got listed property within the equity selection as well. And I believe that the portfolio itself is actually positioned reasonably defensively when we look at assets like REIT. We had Devon Alpha, as I said there. In fact, if I look across Harbour Australasian Equity Income and Devon Alpha, that actually takes probably 2 to 3% of growth assets off that actual calculation. So if I allow for the property, which is 5%, that takes the income assets to 78.5. If I then allow for the fact that we've got a number of fund managers holding cash here as well, we're actually probably up closer to 80% in income assets and only about 20% in growth assets. So quite a lot of work being done at a detailed level as to understand what the risks are within the portfolios. It's probably a little bit early to run through exactly how the fund managers are going through this period. I know we'll get the opportunity to do that once we see their performance up to the end of March. Just looking at the conservative balance portfolio, we're neutral here, but again, we have a defensive equity selection. We've got the Devon Alphas, the Nico concentrated who can go to cash, Equity Income where they can go to cash. We've got a relatively defensive fixed interest funds. You'll notice that we don't have any. We did have, I'll talk about the balance fund in a minute, but we've got very little high, in fact, we've got none the sort of credit exposures that I would be most concerned about in terms of high yield, in terms of exposure to subordinated debt, which you may find in other portfolios. Ours is all fairly simple, fairly vanilla, and mostly investment grade exposure within the bond portfolios. So again, I'm comfortable with that. Now the thinking we're doing now, though, is across the equity selections is, should we be looking at any changes within those equity selections to more accurately reflect whereabouts we are at the moment through this cycle. The balanced portfolio, asset allocation, we're 5% under in terms of where we should be on growth. So we're 5% over in terms of our exposure to income assets here. Again, we've got the defensive equity selection. Again, we've got listed property in the equity selection, which should have a more defensive response to the current market environment. I also want to point out that we had a relatively high proportion in our portfolios of unhedged global equity exposure. You will have noticed that we've seen a significant decline in the New Zealand dollar. Because we have unhedged exposure, we have benefited, we've been buffered to a degree from the impacts of that by our unhedged exposure. Although I would say at the moment that particularly in the investment trust space, we've seen a little bit of a move in discounts as well. We do expect that to correct as some of the managers bring in their discount control mechanisms, but it's a pretty fluid market for them at the moment, pretty volatile market for them, and I think we need to be able to see where that settles. In the growth portfolio, the asset allocation 7% over exposure and the income over the strategic asset allocation with a corresponding underweight in growth. Again, the similar sort of themes, high proportion of unhedged global exposure and a relatively defensive equity selection. I'd point out just a couple of notes here. The Clarity Capital Group New Perspective Fund is going very well. We've seen some numbers from them. Their relative performance is very good compared to the underlying markets, as is AMP Capital Global Companies Fund. I would also point out that intra-meeting, we made a couple of changes to the portfolios over the last 2 weeks. We removed the Bentham Global Income Fund from the balanced portfolio. There was a 5% exposure to that. I started about maybe 2 weeks ago. I started feeling very uncomfortable about potential impacts on credit, and we exited that. My understanding is that Bentham Fund, since we exited, has fallen a further 7%, and I think they could have, there's potential for them to have issues around defaults and illiquid markets, and we're probably comfortable to be out of that for the moment. And then about a week ago, we also reduced the growth exposure across the balanced growth and high growth by about 4% as well, and that was really due to the market uncertainty. What we're looking for now is places and timing in terms of re-entering the market with that. So it's on the edge, it's on the margin there, but I think we could add a little bit of value through that positioning as well. In the high growth portfolio, 6.5% over under on the income growth. Similar issues, similar responses there, and similar assets within there. So look, we have been actively managing the exposures within these portfolios. They were defensively positioned going into what this last three or 4 weeks of market volatility, and we further reduced some of the exposures within there. Time will tell, obviously, as to whether we've got it right, but where we're sitting right now, we have the ability on any further weakness to reposition the portfolios, to take them back to their neutral asset allocation position. I'm not discounting if we see further weakness from here. We may even look at going overweight growth exposure across some of these portfolios as well, as we feel that over time these will be very attractive entry points in terms of long-term performance. But once again, key to all of this is using that asset allocation discipline as our benchmark, continually monitoring the accounts, Individual fund managers have been very active in this period. They've been trying to protect their capital downside. They're also talking to these guys now. They're also starting to position their portfolios for the upside that we think is reasonably inevitable. So we're looking for opportunities to reinstate that growth risk now. We're following the same principles as we've done historically: asset allocation discipline, continual monitoring, trying to talk to the fund managers as often as we can. There will be an end to this volatility, but our view is we're not quite out of the woods yet. Select Wealth, we're open for business. We've got great systems in place as far as I'm concerned in terms of being able to look after this. We're flexible and hopefully responsive. And I believe, look, at the end of the day, if you think you have got any investors out there, we are going to go into a low interest rate environment for some time. We're looking at pretty attractive deals for new investors to come in to the market now. So look, that's all I want to say at this stage. Look, I hope everyone's going well out there. I can surely imagine that there's a fair amount of stress, not only for you, but for a number of your clients. Believe you me, we do understand that. And I can only hope that you are all in a position to be able to respond to that. Please do call any of the Select Wealth team if you do need any further assistance with anything. I know we're being flexible at the moment around some of the processes because, or pragmatic, I think is the word that we're using. Look, I feel for you. I know it's hard work out there. It's challenging for everyone. And if you need anything, give Tahana a call, give Helen a call, give Debbie a call. And I look forward to catching up with you all and enjoying a pre-Christmas drink when things settle down, but we're talking to you before then. Thanks a lot, people, and go well out there.